What is really going on with the Fed, folks? Just days after the first rate cut of the year, Chair Powell steps up to the mic, and what he says next could dictate whether your portfolio soars or gets absolutely crushed in the coming months. Are we heading for a soft landing, or is the Fed still playing a dangerous game of chicken with inflation and jobs? We're diving deep into Powell's latest bombshell, and I've got the technical levels on SPY you need to be watching. Stick around. All right, let's get straight to it. On Tuesday, September 23, 2025, Federal Reserve Chair Jerome Powell delivered a highly anticipated speech on the economic outlook at the Greater Providence Chamber of Commerce in Rhode Island. This wasn't just another public appearance. It was Powell's first official address since the Federal Open Market Committee, or FOMC, decided to implement the first interest rate cut of the year last week, lowering the federal funds rate by 25 basis points to a range of 4% to 4.25%. Now, the mainstream media is picking up on a few key themes. CNN and other outlets are highlighting Powell's distinctly cautious tone regarding future rate cuts. He stressed that the Fed is walking a tightrope, balancing its dual mandate of achieving maximum employment and stable prices. Powell explicitly stated there's no risk-free path ahead, a direct acknowledgement of the challenging economic landscape. He warned against cutting rates too aggressively, which could lead to a resurgence of inflation, potentially forcing the Fed to reverse course and raise rates again down the line. Conversely, he also acknowledged the risk of keeping rates too high for too long, which could unnecessarily weaken the labor market. This stance is particularly noteworthy as it comes amidst pressure from some Fed officials like Governor Michelle Bowman and board member Stephen Miran, who have advocated for faster, more substantial rate reductions, citing a softening job market. Powell, however, maintains that the Fed's policy is not on a preset course and will remain data-dependent. Investors, meanwhile, are broadly expecting at least 2 more rate cuts by the end of the year. So, what does this all mean for us, the retail investors trying to navigate these choppy waters? Powell's cautious tone and the internal dissent at the Fed create a fascinating yet uncertain outlook. I see 3 primary scenarios unfolding from this point. Scenario 1. Measured de-escalation, 60% probability. The Fed continues its cautious approach, delivering only 1 or 2 more 25 basis point cuts by year-end, driven primarily by clear evidence of further labor market softening or inflation steadily retreating towards the 2% target. They avoid aggressive cuts to prevent inflation resurgence. This is likely the soft landing scenario the market hopes for. The S&P 500 could see modest gains, perhaps 5 to 7% by year-end, as corporate earnings remain resilient and the cost of capital slowly declines. The Nasdaq, being more sensitive to interest rates, would also benefit, but perhaps with slightly higher volatility, as the higher-for-longer sentiment might still linger if cuts are too slow. Impact on specific sectors. Technology, beneficial. With a stable, albeit slowly easing rate environment, growth stocks in tech would find a more favorable valuation landscape. Companies like Microsoft, MSFT, and Apple could see continued investor confidence, especially if their earnings continue to defy broader economic slowdowns. Lower rates, even gradually, improve the present value of future earnings. Financials, neutral to slightly negative. While lower rates generally compress net interest margins for banks, a measured approach avoids a rapid drop, which could be worse. Large banks like JP Morgan Chase, JPM, and Bank of America, BAC, might see a slight squeeze on profitability, but robust economic activity, even if slower, could offset some of this. Their diversified income streams would be key. Energy, neutral. Energy stocks are less directly impacted by interest rates and more by global demand and supply dynamics. Companies like ExxonMobil, XOM, would likely trade based on crude oil prices and geopolitical events, remaining relatively insulated from gradual Fed policy shifts unless the economic slowdown becomes more pronounced. Scenario 2. Inflationary reacceleration, hawkish pivot, 25% probability. Despite the recent cut, inflation proves stickier than anticipated, perhaps due to ongoing supply chain issues, geopolitical shocks, or renewed tariff impacts. Powell's cautious approach proves prescient, and the Fed is forced to pause cuts entirely or even signal a potential hike if inflation expectations become unanchored. This would be a significant negative shock. The S&P 500 could experience a sharp correction, potentially 10 to 15%, as higher rates impact corporate borrowing costs and consumer spending. The Nasdaq would be hit harder, potentially seeing 15 to 20% declines as valuations for growth companies come under severe pressure. Impact on specific sectors. Technology, severely negative. High-growth, high-multiple tech stocks would be hammered. Companies like NVIDIA, while fundamentally strong, could see significant multiple contraction. Even established giants like Amazon could face headwinds from reduced consumer spending and higher financing costs. Financials, mixed to slightly positive. Ironically, a hawkish pivot to fight inflation could benefit financials as higher rates boost net interest margins. Banks like Wells Fargo could see improved profitability. However, a general market downturn and potential credit quality deterioration from a recessionary environment could offset these gains. Energy, mixed. If inflation is driven by commodity prices, energy stocks could see a short-term boost. However, if the Fed's hawkishness leads to a deep recession, demand destruction would outweigh inflation benefits, hurting companies like Chevron, CVX. Scenario 3. Aggressive easing, deep recession, 15% probability. The labor market deteriorates much faster and more significantly than currently anticipated, or a sudden, severe economic shock hits. The Fed is forced to abandon its cautious stance and implement rapid, aggressive rate cuts, e.g. 50 basis points or more at upcoming meetings to stave off a deep recession, perhaps even approaching the 2% advocated by some officials. Initially, this could cause a panic sell-off as the market reacts to the underlying economic distress, what the Fed is reacting to. The S&P 500 could fall 15–20% or more. After the initial shock, however, aggressive easing could provide a floor and eventually lead to a rebound as liquidity floods the system, but the journey would be painful. The Nasdaq, while also falling sharply initially, might lead the eventual recovery if investor sentiment shifts back to growth. Impact on specific sectors. Technology, initial sell-off, then potential leader in recovery. Tech stocks would face immediate pressure from an economic slowdown impacting demand for products and services. However, in a heavily discounted, low-rate environment, the potential for future growth could make them attractive longer-term recovery plays. Financials, highly negative. A deep recession would lead to significant credit losses, loan defaults, and a severe reduction in lending activity. Banks like Citigroup, C, would likely see their balance sheets stressed, even if lower rates eventually help some borrowers. Energy, negative. A deep recession would drastically reduce global demand for oil and gas, leading to falling commodity prices and significantly impacting the profitability of companies like BP. So, what's Dave doing with all this, you ask? My personal take right now is that we're firmly in that measured de-escalation scenario, at least for the short to medium term. Powell's caution, while frustrating for those hoping for a quick return to cheap money, is a necessary evil to ensure we don't reignite inflation. I'm not going all in on anything, but I'm certainly not running for the hills. My current stance is holding positions in quality growth names and selectively looking for opportunities in sectors that benefit from stable, albeit slower, economic growth. Now let's talk about the market itself, specifically the SPY ETF. Looking at the charts, SPY is currently in an uptrend, which is positive. However, it's at a critical level right now, folks, sitting right around 665. This is a key resistance point that needs to be watched closely. If we can see SPY hold above its supports at 645, that would be a very strong signal of continued bullish momentum. My next upside target, if it breaks and holds above 665, is 680. However, if we see a rejection at 665 or a break below 645, that's when we need to be more cautious and reassess. The 645 level is our line in the sand for maintaining this current uptrend. Watch those levels like a hawk. What do you think about Powell's latest comments? Are you bullish, bearish, or somewhere in between? Let me know your thoughts and your market moves in the comments below. I read every single one. And if you're getting value from this analysis, do me a huge favor. Hit that subscribe button, ring the notification bell, and smash the like button. It truly helps the channel grow. Remember, this is not financial advice, just my analysis and perspective as a market observer. Always do your own thorough research. And consult with a qualified financial advisor before making any investment decisions. Your capital is at risk.